Hi, I'm Susanna Hart. Welcome to our presentation. I'm with Guild Mortgage.
And I'm Sandra Smith, and I'm also with Guild Mortgage. And today we're going to be talking about down payment assistance programs available in the Bay Area.
So in other words, we're going to be finding the money. We're going to uncover some of the mystery about down payment assistance programs.
What is down payment assistance? We refer to down payment assistance as DPA. A DPA is either a loan or a grant, and it helps you with funds to purchase a home. The funds can cover either your down payment or at times both the down payment and the closing costs.
For example, say we have a sales price of $400,000. You need 3% down typically, and well, say closing costs about $15,000. On a conventional loan, this means that you need to have somewhere around $27,000 to close that loan. This is where down payment assistance comes into play.
What DPAs are available in the Bay Area? We have AC Boost to purchase a home in the Alameda County. They give you anywhere from $100,000 to $150,000 based on your income level. We use what's called the AMI, average median income. We also want to note that it's a lottery. There's also the neighborhood lift. That's applicable for specific counties. You can go on their website and they mark which counties apply. They give you a $25,000 loan. It is based on your income level, and it is going to reopen again on March 22nd and afterwards every following Monday. The third one that I want to mention is the CalHAFA. It applies to both FHA and conventional loans, and it's used to purchase a home in California. Also accompanies two programs. There's the first lien and then the two programs, the Home and the ZIP, which is a zero interest program. It also applies to conforming loans, which are they go up to loan amounts $548,350, and high balance loans, and the max loan there is $822,325.
The other ones here available for the Bay Area is the San Francisco DOUBT program. This is up to $375,000 in a loan amount. It too is based on your income level. You do need to be able to put 3% into the transaction, so you, the borrower, need to have 3%. The minimum loan that we can do for your first loan that you will make your mortgage payment on is 50% of the sales price. The maximum combined, this is our first loan and any down payment assistance that goes with it, is known as a combined loan to value, is 97% of your sales price. Another area that down payment assistance in the area is known as the WISH. This is for low income, or 80% of the average median income. It is a matching program for every $1 as a borrower puts into the transaction up to $5,500. The loan will be $4 to a maximum of $22,000. Then we also have another state-owned program known as the Golden State Finance Authority. These are both FHA and conventional programs, and they have up to 7% in assistance between a combination of loans and grants, depending on the program. But on this one, there's no high balance loans available. So the maximum loan amount is the $584,350.
What is the difference between a loan and a grant? A loan must be repaid. It may have an interest rate, and there may be a forgiveness clause, which means that after a period of time, you don't have to pay it back. Lenders must factor the amount of the loan into the total financing. There may be a FICO, which is a credit score minimum. There also could be income level parameters, and minimum borrower contribution requirements.
There's also programs known as grants. These don't need to be repaid at all. It is money at the table. It's cash to help you in the home. It too may have a FICO requirement, so you may need to have a minimum FICO of no less than, on some programs, 640, 620 and others. It also is income-based, so we may have to have a minimum or maximum income allowed for the loan program. And it may also have a borrower minimum contribution, meaning that you may need to bring money to the table as well. Also, we'll have some tax consequences. We're not professionals on the tax part, so do check with a tax accountant when it comes time to do your taxes.
Minimum requirements. There are borrower minimum requirements, and there's a minimum FICO that is allowed. There's also debt to income ratio requirements. There can be a minimum borrower investment for these programs, money that's coming from you as the borrower. There also can be income level requirements, meaning they typically go anywhere from 80% area median income to 120% area median income. Borrowers' income programs. There's also household income programs. With the borrower income programs, what that means is with certain programs, they look at not just you, the borrower, but if you know that you're moving in with other people in the home, some programs look at the fact that there are other people in the household and they take their income into account.
And then there's loan requirements for some of these down payment assistance programs.
There may be a maximum allowed of only 97% of that sales price. Then there are others that will let us go above 100%, up to 105% combined loan to value, meaning all of the assistance together can actually exceed your sales price. Additional down payment assistance programs may be allowed and combined with others, and others may not at all. There are some very strict requirements. You need to talk to your loan agent about those requirements of what programs may be best for you to combine.
Pros and cons of down payment assistance programs. There are many pros. You can finance a home with a minimum down payment. It also allows you to have a more affordable payment. Some down payment assistance programs have forgivable terms. There are also some DPAs that have grants.
The cons, of course, the lender understands that the more assistance you need, it's a slightly higher risk opportunity. You may have a higher interest rate on your first loan. So do talk with your loan agent as to why that is. These loans, as you've already seen, have repayment terms, and they do need to be paid back even if you're not making a monthly payment. Sometimes they may even have a higher FICO requirement. Each program will have their own specific credit score requirement, so it's very important to understand that. They also have strict debt to income ratios, such as the Cal HFA will not allow you to go beyond 45% of your gross income. Some will allow you a little more expansive, others will be even more strict than that. You may also have to verify all income of household members over 18, even if they're not on the loan. So again, you need to talk with your loan agent to make sure that you understand which programs have that requirement. And this is me, Susanna Hart. Again, I'm with Guild Mortgage. You're welcome to reach out to me, as well as go to my website. Here's my contact information. We do have this PowerPoint also available to download for further information.
And my contact information, even though I look a little different, this is me with straight hair. My information is here, and you can go to my link apply online, and I will receive your application. Thank you for joining us today.
And we wish you all the very best in your search for the perfect home.